YouTube meet Twitch. Twitch meet YouTube. Okay, so this is my first live stream. I've been doing YouTube for years, since 2012. Um, and I thought, well, I was about to do a template that I want to do a walkthrough on, like actually how I build it, and I thought, why not do a live stream? I guess everyone's on Twitch now, so what we're going to do here is it's a SaaS calculation. It's based on, as long as you've got users that pay you a monthly fee and they have the ability to cancel at any point, uh, this template should offer some help. I will be taking suggestions from the Twitch chat as they come in. If this is the first stream I've ever done, so I don't know if I'm going to have viewers, but eventually I'm sure I will. Now, I was going to do this every Monday morning at 9 a.m., but that kind of got nixed because of some other things. So I'm going to be doing every Tuesday morning, guys. Tuesday morning. So if you're on YouTube watching this, every Tuesday morning at 9 a.m., I will be doing a stream of some kind of Excel or Google Sheet build of some sort. Suggestions will be welcomed. And if I don't have anything planned for that day, I'll take suggestions on what I should build or whatever. But this is a little bit of an experiment. We're going to see how it goes. So, let's just start. We want to basically measure the value of. We want to look at ways to reduce churn. So that's like how long your users are staying. How quickly do they leave once they sign up for your services? And how do you retain them better? Well, one way is offering a discount at the point of cancellation. So a lot of big companies do this. A lot of small companies have done this. I've seen recently, and it seems to work. And what the point is, you call up to cancel your service, and the company says, "Hey, don't cancel yet. Here's a discount." If you're the company, well, how much should you discount? What's the discount worth relative to the cost to acquire a new customer? So the main metric here that I thought was really interesting was what's the what's the comparison between the cost to get a new customer versus the cost to give up revenue from an existing customer in order to keep them from canceling. And those two calculations, I think what we'll do is a net present value calculation. So, and I have done nothing. I have no idea. I've just been thinking about this, but I don't know exactly how I'm going to set this up. So let's just try and go real simple at first. So we've got months down the side here, and we'll do 5 years worth of months. That should be enough time. And I imagine I'm going to put this template on smarthelping.com. I think it'll be a $45 template once I'm done with it. All right. So we got months, and then we need to look at both scenario revenue stream or cash flow streams. So scenario one is offer a discount. And, well, we need some inputs up here. So, you want the discount value. Now, I don't know. I'm curious if there's a default, a resulting discount value that pops up. I don't know. We'll have to see when I get more into this. So discount value, we'll do average retention rate to figure out what the monthly churn is. And that can be in years or months, actually. It's easier. Um, so you've got the discount value. You've got the average retention rate. You'll edit cells in light or in light yellow and blue text. Let's just say you'll give them well, we need to know actually quite a bit more things here. So we need to know the average monthly revenue per user. I'm just using user. That could also mean customer or account or whatever. I'm just putting in random numbers here. It doesn't matter because it'll be different for everybody's certain scenario. Okay, so let's just say you pay $250 a month. Discount value. We want to know what else is relevant here. Um, let's put our months. Let's just say the average life for a user right now is 3 years, so 36 months. So what makes sense here to put for the revenue? So if you offer them a $50 discount per month, which is a lot, you put a percentage discount in here. %. Okay. So now we want to know what's the revenue when there's a discount. So we know it's going to be this. Now there's probably more advanced, like you could probably do like a discount, give them 10% off for 12 months and then raise the price back up. But we're just going to assume that the discount applies forever into the future. It's a little bit more conservative way to do this. So offer discount, the user is going to be paying this much per month. Now the retention rate is important. So I was trying to figure out the best way to do retention, and I think it's just assuming you're halfway through, whatever the retention rate is. So if you're at 36, we're going to assume there's 18 months left on the contract, or 18 months left until the average person would leave. So we could do that as another input. Average percentage of user. Average how far, let's see, how do we do this? Length of user life at cancellation. because let's say your retention rate's average is 36 months. Well, that means between month 1 and month 36, after month 36, a user is likely to be gone. But the way you do it with like SaaS churn is every month you basically take an even amount of 1 over 36 and assume you lose that many of that cohort that joined for a given month over time. So at month 18, we're at half. So we'll just put 50% here. My keyboard would work. Come on, keyboard. These new wireless keyboards really haven't been doing good for me lately. Come on. Okay. Come on. 50%. Holy cow. Okay. So 50%, what that means is we got to count. So it's going to be this amount of months forward. And this is just an average because you're looking at just some kind of average number because there's so many variables to take into account. So we'll just do if month 2 is greater than whatever this month ends up being, then 0. Otherwise, take this number. Okay. Lock E6. And it'll just go until the month. So here's offer discount scenario. 20, you offer 10% discount per month. The user is likely to stay. We're just going to assume they're halfway through the average retention rate. So, and there's so many, like, the whole point of this is to increase your retention rate, but you have to have some retention rate to start with to see, um, just to, because they're not going to be, just because you give them a discount doesn't mean they actually stay forever. So this 50% here just drives some number relative to the retention rate for how long this user is going to stay going forward. And the timing is important because you're going to have to measure the difference between the full value they would have, or the cost to acquire a new customer versus the present value of the cost to offer a discount. Because the theory is, or the thinking here is that if you add a new customer, you let the person that had the disc that would only stay for a discount, let them go and just acquire a new customer that charges full price. So cash flow change is going to be, I don't know if it makes sense to take the gross profit. No, because we just want to look at total cash change. So the difference is this minus this. Drag this down. And same calculation if B9 is greater than E6, 0. So $25 is your cost. We'll do this. This needs to be a negative. Oh, no, 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 no. Just change the signs. There we go. So you're losing potentially $450 by offering the discount. Now And hey, we have a viewer. Awesome. What's up? First viewer of the Smart Helping live stream. We're just in the thick of it here, building the model. So scenario one is offer a discount. You lose some amount of cash. Now scenario two is acquire a new customer. And if you're going to acquire a new customer, we can do some advanced calculations for what your customer acquisition cost is. Not super advanced, but just high level. So you go over here. Let's say our average monthly sales and marketing spend is, let's say, $25,000. And average acquired customers is, let's say, 100. So your customer acquisition cost is the spend divided by the new customers. So every customer on average was $250. Why all these went to accounting? Okay. Now, once you know customer acquisition cost, we can do a cash flow stream for the new customer acquisition. Or if we added a new customer, it costs this much, but now they're paying the full amount. We'll add a month 0 in here. So this is going to be this. Negative your CAC. All right, so one scenario you lose $450. The other scenario you spend $250 today and don't lose anything because you'd basically be getting the same $250. So what we want to measure, I think that makes sense, is the present value of these cash flow losses versus the cost to acquire a new customer. And you want, if you're trying to offer a discount, you need to make sure whatever the discount is, the present value of the cash lost should be less than what you're spending to acquire a new customer. Otherwise, it makes sense to let the existing customer go and just acquire a new customer. So now we got to do a present value calculation. Let's just move this over. We look at the present value of discount loss. May have to reference another. I can't remember the formula. So it's I'm gonna pull up another thing here. I don't know what this is gonna look like on your guys' end. I I did a discounted cash flow analysis here on a monthly basis because it's a little bit different. So, oh yeah, I did the IRR for annual or monthly and then turned it. Got it. Okay. So we want to use this calculation. So we want to go internal rate of return of all of this. Wait a second. No, we don't want internal rate of return. Let's see. We want the present value of this, but we want it on a monthly basis, not an annual discounted. Present value. Okay. Got it. Got it. Got it. Got it. Got it. Do a calculation over here. Let's say your discount rate. So this is going to have to be an input. And the higher the rate, the more risky, or the higher the rate, the riskier the cash flows. The lower the rate, the less risky. Let's just say we're at like 13%. So your monthly, if your discount rate is 13%, your monthly rate, which is what you're using to calculate that monthly, the present value on a monthly basis. Here it would be 1.2%, which is just 1 plus the rate raised to 1 over 12 because you're doing it on you're converting annual to monthly, and then minus 1 to get the actual percentage. So we go, now we do this just like a normal present value calculation. So I think we could do, let's see, what is this? This divided by 1 plus the monthly discount rate raised to whatever month it is in the future. So after 1 month, $25 is actually like worth $24.75 present value. We just do this all the way down. And the reason why you do this is because $25 loss in month 18 is not, if your discount rate's 13% per year, then that is actually worth $20 today. And we just want to compare that to our customer acquisition cost. So here it's greater. This is an important row here. Let's kind of bold it. Freeze the panels. And we'll do some visuals and stuff once we have all the data correct, to make it a little bit more meaningful, and probably some color formatting. All right. So we got all our inputs here. Right now it says that rationally we should not be giving these people a discount of 10% because it's cheaper just to get a new customer and have them pay the full amount, 250. Because if you did get this new customer, you acquired them for 250 and then you made $250 a month, that is cheaper than giving a $25 discount for, the rest of the life of that customer, and then they're still, it's not like they're retained forever. The point of doing a discount if they want to cancel is to make your churn lower, but it doesn't just make it disappear. And I think this lever here, the length of user life at cancellation, this is probably a really important percentage here based on the retention rate. I don't know if we should rename this something else that makes more sense though. So if retention rate is 36 months, at some point we have to figure out at what point in the life cycle of the customer, or at what point in the life of a customer are they going to cancel, because it's not, you don't want to do it right at month 36, because on average somebody's going to leave between month 1 and month 36, right? So you don't always just, when you do these calculations with a bunch of people in a bunch of months at a time, you even it out. So one over, at month 2, you've lost 1 over 36. At month 3, you've lost, another 1 over 36. And eventually at month 36, you're at 0, but at month 1, you're at, 35, 36. So we're assuming during that time, well, I guess we could do a different metric here. We could do a different metric that says months retained after discount. And that's going to be, you're going to have to find that data like as you test this, figure out like on average if a user cancels or wants to cancel their offer to discount, how much longer do they stay? And that number is what we're going to have to that number is, I think, more material than what we've done here. So we can just change this here. Uh, what did we reference? That should be fine. Why can't I drag this over here? All right, whatever. So this will be an input. Right, we got, this is average months a user stays after cancellation event or something like that. And then we don't need these. So average months user stays after cancellation event. So let's say they go to cancel, you say, oh, I'll give you 10% off per month. Okay. And then how long do they stay after that? And it could be whatever. We just put 18 months here. It's going to be some function of your actual retention rate, but I don't know if there's any metrics out there that say industry averages for this kind of thing, if this is even prevalent enough to know that. But it's going to be some number. It's not going to be infinity. We could just keep this at 18. So average months user stays after cancellation event, 18. So as a company, you've now lost $409 of cash flow. And you could have just acquired a new customer and not lost any of that cash flow, and it would have been cheaper. So the discount rate needs to be less. Let's say it was 5%. Okay, now it makes sense. Now, if it was 5%, you can keep the new customer and it's actually better financially to keep the new customer. You only lose $205. Now, the present value of all the money you lose is less than the cost to just get a new customer and not lose anything. So I feel like let's just name this the model tab. Um, let's do a visual, which I don't know if we want to do it on the same place. Let's just separate it out. So we'll do a visual here. And what do we want to show? Let's see. We show the present value. And we need to show something with a new customer. So if we had a key, oh, here we go, here we go. We can do a cumulative loss, cumulative discount loss, which is just, this number and then that plus this. This would be a good chart. And see, 60 months I think is a good time. So let's put a chart in here. And I still need to think about all the calculations I'm doing because I don't know how much sense it makes. If this this even makes sense. I know it makes sense to offer a discount to increase your retention rate or reduce your churn, but I don't know if what we're doing here makes sense yet. So let's do that one and cumulative loss here. Oh geez, I haven't done a chart in Excel in a while. Okay, hold on. Yeah, we did all that wrong. So we have the month, the number of months. No, no. We want our data point to be this. So we have our cumulative discount loss and that value. It's here. And then we have our months here. We can do, oh geez. We want this to be low. Give it some labels. Month number. Cumulative loss to discount. And we need a chart title. Now, what I would say if I was running a business here, look at the coolest graphic here in a second. I would look at this and say, well, I know if I offer too much of a discount, the money lost from that is just going to pile up and you won't be able to cover whatever your costs are. Now, we could go more in depth and say, okay, here's your margins, here's your revenue with the discount, what's your net profit, and you could look at it that way. Maybe that's another tab to do. Like instead of looking at the loss relative to acquiring a new customer, which I think this is the most important because this really tells you, like on a cash to cash basis, do I have more money if I acquire a new customer or offer a current customer a discount? And I mean, this amount of months here is going to be a big determining factor. Um, for that, let's say this was like 23 months. Because the longer you have a customer going with a discount, the more it's going to cost. Now, does it make sense to look at the life of this customer as well at a full value? Let's say so this is another calculation we can add, average retention rate. Let's say it's 36 3 years. The value is now, let's see, and month one is always going to be 100%. But here's how you can show churn even with one customer, the value of it. So you do 1 minus 1 divided by 36. And that gives you how much of your initial amount you can, in theory, calculate as revenue while taking into account churn. And you can see it goes to 0 in month 37. And that's because we're assuming it's 100% in month 1. It goes down from there. So it'd just be 1 plus 36 is when you get to 0. And then I like to do the min formula is actually really useful. So I can do our max formula in this case. I want to do a max of this and 0 because I don't want to show a number less than 0. It doesn't make sense. So now I've zeroed out any of the irrelevant data. So I can say a new customer is worth what they would pay times this resulting percentage based on the retention rate. So month 1 obviously is going to be 250, and it goes down from there, and eventually in month 37 it's 0 because that's on average when you lose the customer. So this is another calculation, and we can take, honestly, we could show an IRR of new customer. And this is a monthly basis, but that's fine. 97%. So that's looking at the cost relative to the future positive cash flows. And it takes timing into account. I don't know if this is relevant, but it might be. And the IR of an existing customer, I don't even know if there's a calculation for that. I mean, they're already there. So there's no cost. Like there's no initial cash outlay. It's just they're paying less. I guess you would have to look at their initial cost, show a certain amount of months with them paying full price, a certain amount of months with them paying the discount, and then that's the internal rate of return of a customer with a discount. Yeah, I mean, I think that makes sense. Okay, let's add that. So, so these are kind of unrelated to this other calculation of net present value and the loss from discount. Like this is one way to do it. Let's also look at another way. So a, and this is a non-discounted customer. Let's do a discounted customer. And what we're saying here, discounted customer is going to stay for 18 more months. So their actual total life of discounted customer is going to be the average retention rate plus the amount of months that a discount makes them stay for. And this is where your actual retention rate increases. Because right here, if we annualize this, it's saying every year, well, basically, your annual retention rate is uh, what, 66%. So how do we, oh, we do 1 over the amount of years. So years is this divided by 12. So that should be 60. Oh, and then 1 minus that. 1 minus this whole thing. 67%. So after 1 year, you lose a third. After the second year, you lose a third. And after the third year, you lose a third, and that's gone to 0. So your retention rate by the cancellation increasing your life of your customer by 18 months, which is a lot. I feel like that's a lot. Your retention rate is going from 67% to 78%. Okay, that's a number that's relevant. What else do we want to add here? And don't worry, I'm going to get to this discounted customer IRR after we do this. So total life of discounted customer is 54 months now. That's a 78% retention. So the percentage improvement is in retention rate is this minus this. 17%. So 17% improvement of retention. And churn rate is just a function of retention. So if I say if the annual retention rate is 67%, the monthly, just to show you, I don't know if we want to call this calculation out or not, but it's just going to be 1 divided by this. So your monthly churn, your annual churn would be then this, and you times it by 12, 33%. So you start with 100 customers. In a year, of those 100, you now have 67 left. You've churned 33%. That's what that is. So churn and retention rate are really closely tied. I like to drive every calculation I do in SaaS based on the retention rate, and the result of that is a churn rate. So I feel like this is this calculation of churn or retention rate should have priority when doing any calculation, in my opinion. All right. So we've got one set that says if I offer discount, it gets me an extra 18 months in the extra 18 months cost me $205 if you take the present value of the loss of that money. Then I have, well, a new customer costs, based on these calculations here, $250. So here I make more money, about $45 more, by not acquiring the new customer and putting that cash towards just having it to offer the discount. And overall, I have more money in this scenario here based on all these assumptions. Now, does that really make sense? Like, if I have $1,000 and I have a customer, if that customer leaves and I acquire a new customer, I now have $750, and then I don't lose any money in the future. Or I have $1,000, I lose no money up front, but then over time I lose, well, the present value. Let's do the non-present value. I would lose 225 over the next 18 months. So I now have, instead of I had 1,000, I now have 775 less. Well, I have 225 less. See, this is where this gets real tricky because, like, if I have $1,000, I then have $1,000 plus all this money here. See, I'm trying to net it to the most basic calculation. So does this make sense if I have, this is equal to 4,275 if I just keep the customer for 18 more months? Or this is worth, if I do a new customer and they stay for 36 months, it's worth, I think this is the calculation we want for 375. But we don't have, none of these are being discounted. We're not taking the present value of any of this. We're just saying, yeah, this makes sense. This is the calculation. So I don't know if we need present value of the loss here. And I don't know if that's relevant anymore to, which I thought it was at first, if that's relevant to the cost to acquire a new customer. Because you have to look at what happens after that point in time. So you've acquired a new customer and you get this, or you keep the new customer and this is the cash flow. And whatever cash flow is higher, you obviously want to do. Now, in theory, just like, now here's the other tricky part. So we've taken the retention rate and said, okay, this is worth 250, now it's worth a little bit less because we know on average at some point between month 1 and 36, this customer is going to leave that we signed up. Well, I think you have to do the same average for the customer you keep, but this number is now based on, since we know it's 18 months average life after cancellation event, we can use that to figure out our percentage to apply to the 238. And that should be what it's worth. And I don't think we need this. Okay, so I don't think we need present value of discount loss. This doesn't make sense. We can just say, in this scenario, here's what happens. Or if we sign up a new customer, here's what happens, here's what that's worth. So average value of user over time. Average value of user starts at 100. And here, this will be another really good visual, I think. Average value of this user. Okay, this is cool. This is a cool calculation. So this will be, we always start at 1. This we don't need anymore. All right, so average value of a user starts at 1, and it goes down from there, minus 1 divided by 18. So that's the percentage per month that it goes down by. What did I do here? Oh, and then I did the max to get, yeah. Because we don't want to show negative values, doesn't make any sense. So we'll do max of this or 0. So as soon as it goes below 0, we now see 0. All right, and now we apply this here. Right? And we don't need this cash flow change. Doesn't matter now. Because we know, I think it's easier to just visualize what we have if we sign up a new customer versus what we have what did I say? A new customer versus what we have with a existing customer that has a discounted price. Yeah, this is the calculation. So now does this make sense? 220. What happened here? Oh, I think I had a what did I put here? B19. Okay, we want the same. We want D4 and D2 to still be doing that, but if B13 is greater than 18, then 0. Otherwise, do that. What am I missing here? $238. Now this should be a little bit less. What happened? Oh, this needs to be in a parenthesis, so it does this first and then multiplies by the rate. Okay, that's fine. There we go. So 50%, you're at half, which is 2. Yep, that makes sense. That's good. So we can say what do we want to do at time 0? And what's the situation at time 0 is I sign up a new customer. It costs me $250 right now, and then there's some value that I can assign to that in the future. I'm not doing present value. I don't think we don't need to do present value of anything. So no discount rate needed. And there's some internal, well, I don't even think we need internal rate of return here. This is worth some amount of total money, which we can sum up. So, and that involves the cost to pay out to get the customer, and then the value of that customer at the full price over time. Now, do I want to do that, or do I want to do this? Would I rather accept less money? And here, at a 5% discount, it makes sense to acquire the new customer instead of keep the existing. Now, does this, let's think about this. Does this make any sense? So I acquire the new customer, they pay full price for their existing life. On average, this is what that is. Or now the idea is by offering the discount, you can extend this. Oh, see now we're in it. Now we're stuck in a pickle because so this is the value of what's left. However, we've had like this, let's say this is the customer. You've got month 1, you go to month whatever. We're assuming that it's the end. We now have another, you know, we're basically just changing the life of the customer. So what do we want to capture here? We want to capture the cost of this discount. Do we offer them a discount right away and lose some money in the future, or do we? I think you always want to offer a discount, but I guess it depends on the gross profit, like by how much you can discount. Oh, this is hard. I'm stuck now. I don't know what's actually important here. Oh, crap. Whoops. What happened? Like, because I want to have something that says at some point your discount is too great, but what is that point that the discount it doesn't make sense? I mean, I guess as long as you're still making money, it doesn't matter as long as the discount is not like let's say your gross profit's 50%, then you need to be making like you need to be making you can't discount it more than your gross profit essentially, or else you just be losing money on every user, which is not hard to know. Like if they give me $100, fifty it costs me $50 to service that account as like for hosting or whatever the cost is. I can't discount their price less than $50 or else I'll be losing money. But that's just knowing your margin really. If it's, an 85% profit margin, well, you can discount them even up to, you know, up to really 85%, you're still making money by keeping that customer. So, well, this probably is going to turn into a free template. Um, and it's probably just going to show the value. It's going to show the internal rate of return of discount versus no discount. So here's a no discount scenario. And in the comments, like I'm going to post this to YouTube, feel free in the comments to give me suggestions on calculations that may be useful. Because I'm not sure if my original thesis of discounting the present value of the lost cash from future customers, or from an existing customer paying less versus the customer acquisition cost, I don't think that's actually relevant as much as I thought it was, which is fine. That's why I did this, to figure it out. So let's do no discount scenario and discount scenario. We already know, in theory here, if we say it makes them last another 18 months, it's a 17% improvement in churn. But what we want to see is the cash difference. And I think all that's important here is we have the first 36 months are just like this. The question is, what do we do for the last 18 months that they've stayed with a discount? Like how are we capturing that, and trying to do one stream of value for a discounted scenario? So let's see. They pay 250. This is higher now. I guess this would be, because you can't assume they're not paying the discounted price the whole time. They're paying 250 for the first 36 months, which has some value. And then they're paying whatever 250 minus 13 is for the next 6 months, or for the next 18 months. So we know we can't just say this is now, you know, D5 plus D6 for 54 months and just use 250 and then reduce the value by this amount. That doesn't make any sense, because you lose the whatever the effect of the discount. So if we say, let's just say this is the same calculation as this to start. So to start off, you're paying 250, and we're on this retention rate schedule, right? Now it's 250. So this is identical to this, but something changes after. Now they're gone, but we're saying, oh, wait a second. They're going to last another 18 months, but they're paying a little bit less. Now, how do we capture that? Do we just start at 250, like 237, and then go down from there, do an 18-month schedule? So month 37 is like restarting month 1. maybe. Because we want to say, look, we're extending our customer's life, and as long as the margin is greater than your gross profit, you're going to make more money. It's just going to be better. But how much better is really all we're trying to capture now is how much better. And we can say that IRR. Well, I guess the other comparison is don't do a retention. Let's just say this is 0, or this doesn't count. This doesn't count. This scenario is you pay 250. Let's just look at the actual real cash flows, which is this customer for 36 months is going to pay $250. So if this is greater than this, then 0, otherwise 250. And that's it. We're going to look at the actual cash flow, and then we're going to discount. We're going to use an internal rate of return. Oh, lock D2. Okay. So we have internal rate of return of no discount scenario. And that's going to be this value. 100%. Interesting. Let me change this. Actually, I want to see if this changes this. Let's say it was 4 year or 2 years average retention rate, 24 months. So is that always 100%? Did we just stumble upon like a proof here? 12. Why is this always 100%? Oh, is it because our discount rate? Let's say we charge 50,000. Okay, wait. Now is it always half? Is the IRR monthly always just the initial investment against the monthly cash flow? Let's change this to 10,000 or 100,000. Is this 23%? Just okay, that makes more sense. I guess it's because I was doing round numbers. Let's say this was 250,000. 33. No. Okay. That's okay. Let's say we're spending $18,000 a month on it, sales and marketing. We acquire 38 new customers on average per. What's this divided by this? Real curious here. Does that equal? No, it's close. Okay. So internal rate of return is this is monthly. IRR annual. I guess it really doesn't matter as long as you have 2 internal rate of returns. So come on, keyboard. Doesn't want to work. I guess I need new batteries, but that sucks because I just put new batteries in these like a month ago. Okay. Now this, we got a little bit of a longer formula. We're gonna do, so if the month is less than 13. If the month is less than no. Holy cow, it can't work if this keyboard's not going to work. I mean, this is ridiculous. I mean, if this is how this is going to be, I got to go get a new keyboard. All right, we need a table here. So we have month 1. Our first cutoff is month 30. What do we do here? Well, this has to be greater than the cancellation month. So let's put this back up to like 24. All right, so from month 1 to 24, we get a certain value, and then this is why tables are always better than trying to do embedded if stuff if you can help it. And then this is going to be this. So from month 1 to 24, you're getting the full amount, and then from month 25 to 42, you're getting the discounted amount, whatever that is. Let's say it's 20%. And let's just say the discount is, we'll do this minus that times here. So 10% should be 225. Yep, okay. So here's our table. So we know up to month 24, we're going to pay 250. Up to month 42, or we're going to receive 200. So now all we have to do is a VLOOKUP instead of an embedded if. Look up the month times this table. And it's not going to be an exact match, so we just put 2 is the number of columns to look, and then we don't need to fill in the range lookup. And I always forget, so that's 250, and then this is going to be the 200. And this will just be this plus 1. And we don't need, okay, so yeah, we don't need to know the end. We just need to know when it changes. So we're at 250. Now watch, this is cool. All I should have to do is drag this down. And 250, 250, 250. No. Yeah. So it went 250. And then what I like to do here is we'll put a conditional, we'll put a format color scale. Do we want to do this? It'll just basically change when it changes, but that's kind of harsh to to look at. It's a really light one. No, I don't think there is one. So let's undo that. So you can see it's 250 up until month 25 or 24, and then at month 25, which in theory is when they should be up. We're saying that they're going to pay the discount rate instead of the full rate, which is 200, and you're extending the amount of money you're getting from the customer. Now, as long, and what I guess I figured out from this is as long as your discount rate doesn't put the gross profit of the user below 0, like you just need to be able to make something, then I guess it makes sense to keep that customer. Assuming all expenses related to that customer, um, you're still like positive, even $1, it makes sense to keep the customer and give them as low as price as possible, but it's better to keep them. Um, and there's no real other option because you're still going to be your customer acquisition is still going to have the same cash that it was. So it doesn't really make sense. I think it doesn't make sense to compare your customer acquisition cost to the present value of the lost money from the discount because really if you keep the customer but at a lower price, you're making more money no matter what. Your customer acquisition cost is going to be what it is. Like it's not changing. So as long as the variable profit for a user doesn't go below zero, I guess that could be another thing, user analysis, we'll call it. So let's just look at full revenue, discount, um, discounted revenue, the gross profit of full revenue, and this is important because now you know what that cost is, and by lowering the revenue, your variable costs still stay the same for that customer. They're just paying you less. So that number just has to be above zero. So if we do, this will just be a separate analysis. Well, I mean, we could bring in the numbers. We could bring in the numbers. Let's just say we know our full value is 250. Discount, discounted revenue. Now the gross profit. Let's say your gross profit per user, let's say you're at like 85%. So average gross profit per user equals this times 1 minus this. 30. Nope, 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 nope. It would just be this times that. $212. Because let's say your gross profit was 10%, so that's really low, right? Gross profit really low, so it's saying it'd be what, 25 then, right? Yep. Okay. So that's fine. Average gross profit is 85 is usually the number for SaaS companies. So let's say it's 85%. So you know your gross profit is 213. That means your cost of goods sold, or we're going to call this total variable costs, will be, and you could do 250 times 1 minus 85, or just this minus this, $38. Now you compare that variable cost to your new discount. Let's take this out of here. This doesn't, we want this to be a separate calc. So you've got your full revenue, the gross profit. On average, that means you're making $213 per user, and this could just be on a monthly basis or and it doesn't matter, on some basis, some time frame. It's irrelevant. We just need to know what the total variable cost is. Now we know if we're applying a 20% discount, your actual top line revenue is this. The variable cost are not just, it's not 85% because you're saying the customers are the same. The cost to service those customers is still the same. You're just going to charge them less money. So now we know variable costs are still just $38. So now your gross profit after discount is this. And again, this is basically, it's either this or zero. So as long as it's not negative, it's greater than zero, it makes sense to do the discount. There we go. So gross profit after discount 163. So it's positive. Now let's say your gross profit was like lower, let's say it was 70%. Well, you still have room. Um, you could probably, and look, you have room, you could play with this number. You could actually give them like a 35% discount. And you're still making $88 of profit in whatever period this is for. Right now it's on a monthly basis. You're still making $88 of gross profit that you didn't have before, and nothing else changes. So this is why it's so important, and so like you do not want to lose customers. The lower you could make your churn rate, it just makes everything easier and more money. It's easier. Like you don't have to keep acquiring more and more customers to keep up with your churn as much. You'll get more juice out of the customers you have, and so that's why it's so valuable to offer these discounts. And this helps you do the margin analysis to figure out like what still makes sense. Because if I have, you know, let's say I have the next 10 months and I could have 2 users or 1 user. One user pays 250 a month, or one user pays 250 a month and the other user pays, $163 a month. As long as the customer that's paying 163 still has a positive gross profit, I now have more money than if I just let that customer go without it and not giving them the discount. Now the key is, and this is why companies won't offer you this until you go to cancel, is because they obviously don't want to charge, less in general. Okay, so IRR discount scenario. It's obviously going to be higher because it's just more money. It's more cash flow with the same initial cost. It's just you have a lot more cash. So the difference here, wait, what? I guess it could be the same if it's so minuscule. Hold on. Discount, no discount. Okay, I mean, is it that minuscule? These don't equal each other. At what point do these become different? Okay, so it's really, really minuscule, the difference in internal rate of return of this customer versus this, because by month 25, if you're looking at month 0 to 25, the value of 163 is worth almost as much as 0 if you're looking at today. However, if you get to month 25, you're making an extra $5,850 over the next 33 years. Hold on a second. Hold on, I messed it up. No, I didn't. No, I didn't. It's going to 72, doing the whole thing. This is doing the whole thing. So in terms of like an investment analysis, it's not, these two scenarios aren't much different, but on a cash flow basis, they are very different. But what this means is if you looked at the present value of these future cash flows, the present value would actually be pretty close, because the discount rate to make the value of the future cash flows equal the initial cost of customer acquisition is pretty low. Or I mean, it's not low. It's nearly the same, 52.7771, 52.7758. So that's not really useful. Let's do lifetime value. And we can do a bunch of other metrics based on this if I can get this to work. Come on, keyboard. All right, I got to get a different keyboard with a wire. This is insane. Okay. Uh, so cash lifetime value. Actually, hold on a second. I don't know if this will change much, but let's get these IRRs back in here. Let's say this is like 100,000 because our numbers are okay, and that then becomes a little bit more relevant. Because I had such a low acquisition cost that it just the future cash flows relative to that were just so like you were paying back your customer acquisition cost in like a month and a half, which is not really realistic. I mean, it's really good if you can get that, but that's not common. So 9.1% with a discount, which is the the discount scenario will always be higher here because it's just the same cash flows, but then a little bit less for longer versus zero. That's always going to be higher. Um, what we want to look at though is some other advanced metrics. So in this, we can look at customer lifetime value. And let's do it this way. Let's just go over here. We have more space. So we're going to say we want to see um, this will be a data point value, months to pay back customer acquisition cost. And then we'll have discount to the user, non-discounted user. Okay. This will give a nice breakdown of the differences of doing each. So discounted user is going to get, it's just this. Oh no, hold on. It's the sum of all this. Non-discounted user stops right away. So, and then the months to pay back. So this is going to be simply the same for each because it's very likely that you're paying back the customer acquisition cost before the well, if you're not paying back the customer acquisition cost before the average user leaves, then you're definitely losing money over time. So those will always be the same. We'll just put it in here. So it's just going to be uh, your customer acquisition cost divided by your revenue. So in 10 months, you're paying that back. Usually you want to get that down to 6 or less. Okay, and that's the same for both. Doesn't matter. Um, another important metric is your lifetime value to CAC, which is going to vary between them. So here, you're looking at a ratio of, let's see, total value of 11,000 divided by 2.6, so 4. And then here, this is going to be 6,000, 2.2. So this number, the ratio, you obviously want the lifetime value to be higher than the customer acquisition cost, and that ratio, if you can get it above 6 or so, is pretty good. Um, but anywhere like between like 3.5 and 7.5, I mean, is or anything above 3.5 is really good. What sucks is we no longer have a visual at the moment. That makes sense. All right, so key metrics. All right, lifetime value, months, retention rate, annual, discounted is now at, on average, we're saying 71%, and this is 50%. Um, so this is pretty, I mean, this isn't super complex, which is probably good. It's pretty easy to understand. I just don't know. I mean, I guess this is the best way to show an apples to apples comparison. They pay 250, then 163, or they pay 250 and stop. What does that cash flow look like? What is the lifetime value? What's the retention rate difference? Because why it's hard to do a nice smooth like number with that retention and the value going down over time, which is I think what you should do, is because you've got, yes, the discounted customer has now a life of 42 months, so an annual retention of 71%, but you can't like do a smooth percentage and apply that to the revenue and get like a value. Because if you say somebody on average is going to last, let's say 3 years, you want to take 1/36th off of that value every month because you don't know if they're going to be there in month 3, 4. You just know an average is 3 years. But when you say that they're going to be there an average of 3 years, or let's say now it's an average of almost 4 years, and some of that time they're paying a certain amount, and then another time they're paying less. Well, what do you discount? What number do you actually use to apply to what percentage? I don't think it's possible to get a clean number. So we're just gonna have to do it like this. And I feel like there's still some value here. It's definitely good to know. This margin analysis will help you figure out what you can give existing users like a discount of versus what your new users are paying to try and increase your or reduce your churn. It's just a simple money thing. Uh, and again, I'm open to suggestions on this. I really would like feedback on what might be useful to add to this analysis. And I'm still thinking here if there's anything else I could do. Um, let's see, CAC, LTV, LTV, CAC. Oh, months to pay back. Yeah, we did that. 10 months. Right, because at 10 you're at 25. 27 is when you break even. But I think these are good general metrics if you're running a SaaS business to shoot for. Like, you know how much on average you're charging people. You should be able to calculate how much you're spending to acquire new customers on average. And those two things in conjunction are you can do a lot of analysis here. Like these four metrics are pretty important, especially these two are actually really telling to what you're doing and how your business is doing, and it's all based on retention. Now this with the gross profit stuff, I think this is good to show like your discount. Obviously this can't be under zero, but uh, okay, so I can do a visual of the total value. So we can do total value, discount, total value, no discount. And the whole premise here is that if you discount, your customers will stay longer. Um, we'll actually do a cumulative value, including the customer acquisition cost as well. So this plus this, and on down the line. You can see when you break even, this is like your months to payback CAC. This is what that equals, which is the same for both and based on the current scenarios. But see now that you get to different numbers here at the end. Yeah, I think I'll put this analysis in here. Um, we have this discounted. Oh wait, hold on. We don't need to go up here. So we have this discounted value. We have no discount and the value. Okay, that's kind of a cool chart. So bottom. We'll title this total running user cash position. Put a legend in here, obviously. Put this at the bottom. Yeah, I think this is actually a pretty good chart. It really shows you we already know what this is. There's only one type of data point, so we don't need that access. This is month number. All right. What chart looks cool here? Let's see. I think the line chart makes the most sense, but I don't want data labels. I guess that's pretty easy to read. I'll just do a little light gray background, black border. So you can see running user cash position. Actually, we want to really highlight where zero is here. So I need a different chart. What really shows where zero is? Do any of these? That shows a line. That kind of looks cool, but I want to see like that needs to be clear that this is negative. Like this is where you break even on the life of your customer as far as on a total revenue basis. Here we go. That's kind of nice. So you can kind of see there's where you're breaking even. This is where your cost or your amount of month it takes to pay back that initial cost. Um, Now, some people go on a gross profit basis, so they would just apply um, the cost, which is, let's see here, we're saying the gross profit to 85%. So they would apply this $75 per user and then take the value after this total revenue and then use that to calculate all of this stuff, which is, you know, that can be added, but I'm just doing it on a total revenue basis for now. Make this a little bit bigger. Do 12, 16, put it bold. All right. I don't really know if we need to do a color. Maybe a light blue. Eh, it's kind of hard to see the line. Okay, that's fine. Okay. I guess this is pretty good. Um, so what I'm gonna do is, oh, now what? Why is this saying there's an error here? Oh, there we go. So this is definitely just gonna be a free template. I'm just gonna post it up, and I'm looking forward to comments about possible calculations that might be useful here. But this is basically as far as I think I can go with this template. Um, so I'll just post. I'll probably upload it to Google Sheets, or it'll be a file upload so that I can just link it into the description box and it can be downloaded to Excel from there. Um, but yeah, I don't know if there's anything else I really want to do with this. I was really surprised. I thought that it made sense to calculate how much you're losing on the discount versus the cost of acquiring a customer, but really that doesn't make sense to even look at that after trying to model it out. And that's the thing with models is you have an idea, but when you actually go to build it and look at the logic, it gets way more clear if it makes sense. So all right, well that was about an hour and 43-minute stream. I guess I'm gonna end it and I'll try and do something else next week. Again, it's going to be Tuesday at 9 instead of Mondays. It'll be every Tuesday at 9, and we'll see how this goes. I'm going to post this to YouTube. Hopefully, that'll get more awareness. It's probably going to take months, like 6 months or a year, to get this going. I'll have to keep doing it every going forward. It'll be every Tuesday. But this does increase my output, which I wanted to do. I wanted to do more templates. For everybody and just get that production up. So I'll see you on the next one.